Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us is Alex Mashinsky. He's the founder of Celsius Networks. We're going to take a look at all roads leading to decentralization. Alex, it's great to have you with us as always, and a topic that you and I have covered frequently in the past. And really, there is this war between centralization versus decentralization when it comes to assets.
Yes, we are living through amazing times that even the fiction books could not have predicted. Oil going negative, interest rates in the U.S. going to zero negative, and the stock market's going up and down 30% in a matter of days. And so there's definitely an earthquake going through the financial system. And I wanted to spend a few minutes, and thanks for having me again, but I wanted to spend a few minutes just kind of putting it in context, because basically there's two schools of thought. There is the Keynesian economics, right, where most of our Fed governors and the people who are running our economy, they're all believers of the Keynesian economics. And they believe that if the economy gets into trouble, it's the Fed's job to jump in and basically fix everything, right? Where the Austrian economics, the decentralized version, is that we have to let the economy do what it does, and the recession or even the depression is a natural part of the cycle that we need to process through. So on my slide here, I'm basically showing you that the pyramid that we live in, the bubble that we live in, where 1% of the population controls all the assets and all the income, is really is unsustainable. And all we've done in the last 4 recessions is basically reflate ourselves out of trouble, kicking the can or kicking the whole planet down the road. And this new model of decentralized finance, where decentralization is what really dictates the free flow of economic activity with limited supply, like the Bitcoin, is the future. So moving on to the next slide, the Federal Reserve has printed more new money in the last month than it did in the last 100 years, right? So we went from a balance sheet that up to 2008 was less than $1 trillion. Then QE got us to like $3.5 trillion. And now we're going to reach probably in the next 2 years, over $10 trillion of total assets that the Fed holds. And all these assets are here to prop the prices to prevent a recession or prevent depression, right?
Right, and that's exactly what you were saying before, that it views a down stock market, and it's not allowing the economy to go through this cycle with everything being propped up. But I think your next chart here is really interesting, where all roads have led to decentralization if you look at it from a historical perspective.
Yeah, so if you take the last several thousand years, you would see that we went through booms and busts, and we had several basically empires that kind of dominated the commerce on the planet. And you can see that the US dollar is not like everybody thinks that the US dollar was here forever, but really every 100 years or so, we moved from one empire to another, or from one economic system to another. And you've heard Ray Dalio and many other people talk about the fact that we're kind of finishing an era and starting a new one. And what I'm trying to say is really that, again, what the Fed is doing long-term is hurting the US economy. It's hurting the dollar. The Fed's job is really just to keep the dollar and make sure that we can pass it to our children and grandchildren as this golden goose that lay golden eggs. And what they're doing by printing all this money is basically drawing on the power of the dollar to fix a problem today that we should have fixed with just letting the bad companies die, right? And that's not what we're doing. We're bailing out everybody. We're socializing losses. So,
right.
And a lot of this has to do with credit, right? I mean, we live in that's my next slide. We live in a fractional reserve system. Again, this is part of this Keynesian economic system in which demand is what cures all ills. And we're allowing the banks to print or essentially create money through credit. And all of that effectively is just borrowing from the future. When we create credit, we're borrowing demand from the future. And again, Austrian economic theory is really based more on savings and not on spending what you don't have. So sooner or later, we're going to have to pay the piper. We're going to have to pay all these bills. And that's what causes recession or depression. And right now we have, again, tens of trillions of dollars worth of debt that is outstanding, and pushing that further out is getting harder and harder and so on.
Yeah, so if we look at the next couple of slides here, if you take a look at our total world debt versus the total world's assets, it's going to be really hard to balance that out at some point. I mean, we're nearly even on what's owed, and that's, I'm sure, going to skyrocket to the other side, where debt's going to eventually outweigh what the assets are.
Right, and these numbers were taken before this recession hit, right? So if you look at 255 trillion in asset, that was before everybody took a 20 or 30% haircut. So now the debt burden is actually greater than the asset burden. And what the Fed is trying to do is reflate that bubble instead of fixing the problem, recycling through some of the debt, converting that into equity and so on. What the Fed is basically saying, no, we're just going to put a put under the market. Everybody's going to buy assets again, and that's how we're going to go back to normal. So that's not, in my view, not a long-term solution. The next slide, it's talking about the concentration of banks. I overlaid 2 slides of basically how many banks we used to have. Now we're down to 4 too big to fail, and how interest rates have come down during that time. Now they're basically zero. You can't earn any money on your money. And what the banks and the Fed is doing is they're robbing the retirees, they're robbing all the hardworking people, and giving all those profits back to the people who have assets, or people who can borrow, who can buy assets, because basically money's free, right? And those who can borrow these assets can make as much as they want on money that they can borrow at zero.
Yeah, and I think if we take a look at the next slide here, I think this is really a big concern and a large part of the conversation that we're having right now when it comes to the worker, where productivity is certainly skyrocketed with the advent of the technology that's available to us as we become more of a services sector, but compensation hasn't kept up with that. And this disparity, this widening wealth gap, it is not going to get any better unless we bring those two closer together.
That's right, and you can see they were in parallel. They were running together until we went off the gold standard. And after we went off the gold standard, if you were in computing, this is what the microchip was invented in 1971, and we went off the gold standard the same year. Those two events really created this bifurcation between productivity that was generated through the internet and through computing or through the financial markets, and basically everybody else who was not in one of those two categories did not see their compensation or their life kind of standard of living improve. It kind of stagnated in the 70s. And my last slide is talking about really the alternate universe, right? The alternate assets. And today we have basically Bitcoin is like for the extremist, right? If you're in the comfort zone of holding dollars and you look at Bitcoin, sometimes that is too far. It's a jump too far for most people. And part of what at Celsius, what we're trying to do is really created a wallet that allows people to invest either in gold or stable coin or digital assets, but they can choose the asset class. It's still, all of these products are digital products. They can choose the asset class that is detached or non-correlated to the fiat currency that they're holding. And so effectively, they can basically bet on the fact that the Fed printing $5-6 trillion is going to eventually create inflation, is going to create a debasement of the currency. And you rather have your savings either in gold or in digital gold to basically detach yourself from that debasement.
All right, Alex, great to have you with us as always. Thanks so much for joining me on Trade Talks.
Thanks for having me, and let's hope that we all get through the corona and this recession with ease and comfort.
Yes, I agree. Look forward to having you back in studio sooner than later. Thanks so much for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.